Hi, and welcome to Global Financial Bridge Knowledge Series. Today we're going to discuss whether our business is actually cash absorbing or cash generating. I mean, that in its own is a reasonably interesting question. Once again, as always, the answer is found in our standard set of financial statements. I think for some of you by now that may have viewed some of our educational content as such, have come to the sort of conclusion that yes, the wealth of knowledge that lies in our financial statements is amazing. And I'm sure most of you would say, wow, why are we not using our numbers like this? I mean, it's just amazing that we don't. And the other thing that's important about it is speed. If people do use these principles, the speed by which they can identify these potential areas of dysfunction and really home in on how to improve these areas is fantastic. So, okay, back to the story. How do we look at our financials and identify whether we're cash absorbing or we're cash generating? Once again, standard set of financials don't tell the story. How do we go about it? Well, we just move straight into the one-page scorecard and let's see if our story can be easily explained in this environment. For those of you that are new, here we have our income statement, our balance sheet, and we connect our income statement and balance sheet to those key areas that measure both performance and value. First thing that we're going to focus on now is the ability for us to connect what happens in the income statement and what happens in the balance sheet. To do this, our focus is going to be on two specific areas within those two documents. The first area, we're going to focus on this thing called gross profit, or if you wish, you can call it gross margin. And the second area we're going to focus on is this thing called working capital. At least our definition of working capital. Now you'll most probably see why we define working capital the way we do. Right, what is happening to this business? Let's have a look at that level. What we're going to look at is at the gross profit level, because at that point we're comparing income statement with balance sheet on a one-to-one basis. Think about it. Income statement to balance sheet on a one-to-one basis. Now, how is that possible? Well, let's think about this. From a profitability or income statement management viewpoint, our gross profit is generating 37 cents per revenue dollar. Okay, so every day we have this revenue dollar, we generate on average, this is just on average, 37 cents per revenue dollar. Now, how do we look at the balance sheet? The balance sheet has a very interesting measure. And this measure is called working capital per dollar of revenue. So remember, margin is the same thing. In the income statement, this number, this 37 cents, is margin per dollar of revenue. Margin per dollar of revenue. Remember, we said we want to compare income statement with balance sheet on a one-for-one basis, or apple for apple basis. I don't know where this apple for apple came from, but anyway, you know, nothing like fruit. So here we have our gross profit per revenue dollar of 37 cents, our working capital per revenue dollar. So all we've done is we've taken our total working capital, and remember the way we define working capital, and this is why it's important. Receivables plus inventories less payables. So there it is. Receivables of 557 plus inventories of 770. And for the accountants in you, go and take out your calculators and go check it out. Okay, so 557, 770 less our accounts payable of 567 will give you $759,000 for the current period. Right, working capital per dollar of revenue. 759 divided by $3.7 million will give us 20 cents per revenue dollar. So now we have a comparison. So for every dollar of margin, and this is important, for every dollar of margin and every dollar of working capital, we now have a unique comparative. What we can do is, what we can say is, for the next revenue dollar, what does the income statement generate? Think about it. When we grow our business, right? So for the next revenue dollar, how much gross profit or gross margin does our income statement generate? Next revenue dollar. Obviously, 37.84 cents. Call it 38 cents, right? For the next revenue dollar, how much working capital does this business absorb? 20.54 cents. If you think about it, for the next revenue dollar, we generate 37.84 cents. There it is, 37.84 cents. And we absorb 20.54 cents. For at the gross profit level, is this business cash generating or cash absorbing? Well, if we're generating let's call it 38 cents, and we consuming 20 cents, then if we quickly go to our cash statement here, or our cash window, we will notice we have this very easy measure, percentage cash per unit of growth, so per dollar of growth, which is really the amount by which this business is cash generating when it grows at the gross profit level. We're not taking into account the variable operating expenses, etc. It's just at the gross profit level. We will generate 17 cents cash flow on each additional revenue dollar. Prove it. I love this stuff. Once again, let's grow this business. We're going to grow this business from 23% to 30%. As we've all seen, the income statement has changed, the balance sheet has changed, but what we want to identify is the degree by which this business has grown in its cash flow at the gross profit level. Okay, a couple of things that we need to be able to prove. So we're going to look at the net impact on what's happened. According to this, the net cash flow has actually declined. So in other words, this has absorbed $6,000 due to the $200,000 growth. Isn't this in contradiction to what I previously said? Well, possibly. But remember, I was talking about cash flow at the gross profit level. Go and see if I can prove my point. Okay, so the first thing that we do need to know is, let's go and have a look. We need to look at our cash flow statement. Remember, in our cash flow statement, we now have the ability to compare cash flow at what we call the cash gross profit. 3.7 million, that's our actual cash. 3.7 million is our actual revenue. 3.9 is our what if revenue, and there is our net difference. At the gross profit level, we have generated $34,000 of cash flow. Do you see that? So after we've taken into account the movements of our receivables, our inventories, and our payables, the net impact on cash is $34,600. So how did we calculate? Very simple. Let's get back to the scorecard. What did we say? We said that in our cash flow, the net difference between our margin or gross profit per revenue dollar and our working capital per revenue dollar is 17.3 cents. Okay, so please remember that number, 17.3 cents. That is the net difference, okay, between what the income statement generates and the balance sheet absorbs. And how much did we grow our business by? We grew our business by $200,000. So if I take $200,000 times that 17.3 cents, what do I get? For the accountants in you, I will just quickly do this calculation. So it is $200,000 multiplied by 0.173 is equal to $34,600. There it is. And to go back to our cash flow statement to prove it, okay, we got 34,601. There's a little bit of a rounding difference, but I think you can see the principle. Nice and easy. So when you grow, and remember this is based on a equal comparative periods. Please remember that. Calculations are a little more complex when you're not on equal periods. So 12 months to 12 months, in other words. But isn't that a great little way to look at your business? So the first thing is, what do? Step number one, let's get back to our original numbers. Scorecard, undo. So step number one, we just work out what is our margins. We know what that is. Margins, very easy, is our revenue less cost of goods sold is equal to our gross profit. Okay, our direct cost of goods sold, that's equal to our gross profit. Gross profit divided by revenue is equal to our gross profit percentage. We calculate our working capital, receivables, plus inventories, less our vendors, or our accounts payable. This is our true accounts payable. In other words, we're looking for that variable capital per revenue dollar, and that's what we call working capital, because the outcome of working capital is cash. If you take that, you know what your working capital is per dollar of sales. Gross profit minus working capital is equal to the fact that you are cash absorbing or cash generating at the gross profit level. Here's another interesting point. If you have a reasonably strong variable cost structure, you could even look at the same formula at the operational level. See, at the operational level, this business has a bit of a problem. If all its operational costs are mostly variable with revenue, then you would compare your working capital with your operational profit per revenue dollar. And under that circumstance, you would be cash absorbing when you grow. Well, I hope you enjoyed our little knowledge bit on am I cash absorbing when I grow. My name is Andre Geen, and we use Global Financial Bridge in order to have this discussion.